Next reading is Fundamental of Credit Analysis. We're going to do end of chapter questions from curriculum. The first question is pretty straightforward. The risk that bonds credit worthiness declines is best described by clearly its credit migration, or what you call the downgrade risk. It means the risk that the issuer credit worthiness may deteriorate over the period of time or migrate to a lower point. So that is straightforward. A is the right answer. Next, Stead Smarts Limited and Finermo Limited are alike with respect to financial and operating characteristics, except that Stead Smarts Limited has less publicly traded debt outstanding than Finermo's Limited. Stead Smarts Limited is most likely to have, since for Stead Mart it has less publicly traded debt. So what is most likely for this firm? No market liquidity risk at all. Wrong. For corporate bonds, publicly traded debts of corporation, there will always be an element of liquidity risk. So this is wrong. Low market liquidity risk, wrong. Since it has less traded debt, so it is going to have comparatively higher market liquidity risk than Finermo's Limited. So that makes C to be our correct option. Next, question number 3. In the event of default, the recovery rate of which of the following bonds would most likely be the highest? Which of these bonds would have the highest recovery rate? So of course those bonds that are highest in hierarchy, the one that would get the highest recovery rate is first lien loan or senior secured bond. So that gives you the first mortgage debt. A to be the correct option, and A it should be. Next, during bankruptcy proceedings of a firm, the priority of claim was not strictly adhered to. Which of the following is least likely explanation for this outcome? Senior creditors compromised. Yes, valid explanation. It can happen. It is likely, not least likely. It can happen. A judge order resulted in actual claims not adhering to strict priority of claims. Yes, if the judge orders so, company is bound under the law to follow the judge's order. So this can happen. The value of secured asset was less than the amount of claim. So this is not the reason why the priority claim was not strictly adhered to. See, now let's say this is your pledged asset, 100 million. But this was not sufficient to fulfill the claim. So the unfulfilled claims, they will become senior unsecured. So any deficiency between the pledged asset and the claims against them becomes senior unsecured debt and still adheres to the guidelines of priority claim. So this is the least likely explanation. So that makes B to be our correct option. Next, a fixed income analyst is least likely to conduct an independent analysis of credit risk because credit rating agencies, least likely, remember, credit rating agencies may at times misrate issues. That's the very valid reason. That's the reason analysts may conduct independent analysis. So it is a valid reason, not least likely. The rating agencies often lag the market in pricing credit risk. This is true as well. That is the reason why an analyst would like to conduct her own independent analysis. Because credit rating agencies cannot foresee future debt financed acquisition. Now this is incorrect. This is least likely because both analysts and rating agencies, they have difficulty foreseeing future debt financed acquisition. So that is least likely to happen. So that makes C to be our correct option. If goodwill makes up a large percentage of company's total assets, this most likely indicates that the company has a low free cash flow before dividends. There is no such correlation between goodwill and cash flow available with the firm. There is no such generalization that we can make. There is low likelihood that the market price of the firm's stock is below book value. Again, we cannot presume such likelihood to whether the market price is above or below the book value. A large percentage of the company's assets are not of high quality. That is the right, most likely situation. That if the goodwill makes up a large percentage of the company's total assets, this most likely indicates that a large percentage of the company assets are not of high quality. Why? Because intangibles like goodwill, they are considered as a lower quality asset compared to with physical plant and machinery, real estates. So they are considered to be better than the goodwill. So that is because they can be easily sold and they can more easily be converted into cash than goodwill. That's why intangibles like goodwills are not considered of high quality. So that makes C to be the correct option. Moving on. In order to analyze the collateral of a company, a credit analyst should assess the cash flow of the company, its capacity. We're looking for collateral. Soundness of management strategy, that could be the character. Value of the company's assets in relation to the level of debt. Perfect, that's collateral. That's the value of the company's assets in relation to the level of debt. It is important to assess the collateral of the company. That is the quality and value of the assets that support the debt levels of the company. Next question, number 8. In order to determine the capacity of a company, it would be most appropriate to analyze the company's strategy. That would help us assess the character. Growth prospects of the industry. Yes, that is a measure of capacity. The growth prospects of the industry provides the analyst some idea, some insight regarding the firm's capacity to make payment on coupon and the principal. So this is true, this is capacity. And aggressiveness of the company's accounting policies. Well, that is character, not the capacity. So that makes B to be the correct option. We are looking for capacity, and that's B. Next. A credit analyst is evaluating the credit worthiness of 3 companies: a construction company, a travel and tourism company, third, a beverage company. Both the construction and travel tourism companies are cyclical, which means there will be more volatility in earnings, whereas the beverage company is non-cyclical, less volatile. The construction company has the highest debt level of the 3 companies. So we are now in a position to identify that construction company has high volatility in earning, and it also has got the highest level of debt. So the highest credit risk is most likely exhibited by not beverage company, it's non-cyclical, stable earnings. Travel and tourism, yes, it has high volatility, but we don't have any indication regarding debt. But look at construction company, it is highly leveraged, which increases the credit risk, and also it has higher volatility in earnings. So that makes A to be the firm with the highest credit risk. A it is. Next. Based on this information provided in Exhibit 1, the EBITDA, that is earning before interest, tax, depreciation, and amortization coverage ratio of Adidas AG is closest to. So basically EBITDA coverage ratio, for that we need earning before interest and tax. Before interest and tax, take your operating income, add any amortization, depreciation back to this number. So you will have 894 as your operating profit. Add back depreciation and amortization. Nothing else to be added. So 249. Upon the interest charge, which is 113. So simplifying this will give you 10.12 times. That's the interest coverage using EBITDA. So that makes to capital ratio. All right. Now for debt to capital ratio, we have debt given as 1613 million, but we do not have the total number of amount for capital. So simply adding the debt and the equity, these are the total funds deployed in the business. So adding these two, 1613 plus 4616 million. So that would give you 1613 upon 6229, and it would be approximately 25.90%. That makes B to be our correct option. Next. Funds from operations of Pay Handle Limited increased in 2011. Good thing. In 2011, the total debt of the company remained unchanged, while additional common shares were issued. What does it mean? Debt stayed the same, common shares were issued, so it means debt to capital, this ratio improved. It's now lowered because the denominator is bigger and the numerator had stayed the same, so lower the better. Pay Handles Limited ability to service its debt in 2011 as compared to 2010 most likely has improved. Why? Because debt has stayed the same and company has issued more shares. Resultantly, overall debt to capital has fallen. So the firm's ability to service its debt has increased over the period, has improved. So without any doubt, we can say A is our right option. Moving on. Based on the information in Exhibit 2, Group A credit risk is most likely. So we have been given the industry median versus the Group A data. Total debt to total capital, well, this is not good. Industry median is better than Group A. Then funds from operations to total debt. This number is much better for Group A. Return on capital much better than the industry median. Total debt to EBITDA, earning before interest, tax, depreciation and amortization. This is even better. And finally, EBITDA interest coverage, much better than the industry, almost 3 times better. So what now we can conclude based on the information in Exhibit 2, Group A credit risk is most likely lower than the industry average. Why? Because it is performing better than the industry on 4 counts out of 5. So we can be sure that it has lower credit risk than the industry. A is the right answer. See, 4 out of 5 credit ratios. So moving on to the next question. Based on the following information in Exhibit 3, the credit rating of David Campari Milano, a joint stock company in Italy, it is pronounced as Societate Razzoni, SPA, that's a joint stock company in Italy, is most likely. This is the firm here compared with the Associated British Food PLC as well as the European Food, Beverage and Tobacco median numbers. So total debt to total capital, this is the best amongst all. Funds from operations to total debt, the best. Return on capital, total debt to earning before interest, tax, depreciation and amortization, this is the best number here. And earning before interest, tax, depreciation, amortization coverage ratio, the best number is for Associated British Foods. Now, based on the information in Exhibit 3, the credit rating of David Milano is most likely. You can see for the British firm, the numbers are good, but for David, not good. So we can say that the credit rating of David Campari is most likely lower than the Associated British Foods PLC. Not same, not higher, lower. A. Holding all other factors constant, the most likely effect of low demand and heavy new issue supply on bond yield spreads is that yield spreads will, first of all, when there is low demand means wider yield spread. And at the same time, heavy supply will further widen the spread. So we can say that for sure that low demand and high supply will widen the yield spread. Without doubt, it's A. Next, credit risk of a corporate bond is best described as the risk that an issuer's creditworthiness deteriorates. Now let's first define what did we read in our reading. Credit risk is the risk of loss resulting from the borrower, the issuer of debt, failing to make full and timely payments of interest and principal. That's how we define credit risk. So this is perfectly summarized here in C. Risk of loss resulting from the issuer means the borrower, failing to make full and timely payments of coupon and principal. So that makes C to be the correct option. Why not A? Risk that an issuer's creditworthiness deteriorates. This is the credit downgrade. Probability that issuer fails to make full and timely payment. It is default probability. So we know for sure now it's C. Next, the risk that the price at which investors can actually transact differs from the quoted price in the market is called. Now let us first discuss these three options and then you will select which amongst them is the correct one. First, let's discuss spread risk. Spread risk is the gap between the debt instrument's yield and the yield of default-free government bonds. So let's say this 3%. So this 7%. So the risk that this spread may increase, this spread may widen beyond 7% is called the spread risk. All right, let's erase this. Next is the credit migration risk. We have discussed in our reading. Credit migration, or sometimes called the credit downgrade risk, is a risk that a bond issuer's creditworthiness may deteriorate, resulting in higher risk of default, right? And then what is market liquidity risk? The market liquidity risk is the risk that the price at which investor can transact buying and selling a particular bond, that price that he sells at or buys at, it may differ from the price indicated in the market. And that's exactly what we're looking at. The risk that the price at which the investors can actually transact, buy or sell, differs from the quoted price in the market is called the market liquidity risk. And that gives you C to be our correct option. Next, question number 18. Loss severity is best described as which of these following? The default probability multiplied by the loss given default? No. This is called expected loss. Expected loss is equal to default probability times loss given default. B. Portion of bond's value recovered by bondholders in the event of default is called the recovery rate. This is not the right option then. Then it must be C. Loss severity is best described as the portion of a bond value, including the unpaid interest, an investor loses in the event of default. It's a straightforward textbook approach based question, and that C is our right answer. The two components of credit risk are, one of them is default probability and other is loss severity. That's what we have been discussing. Then what about spread risk and market liquidity risk? They are not as such components. They are related to credit risk, but they are not components. Components are loss severity and default probability. Next. For a high quality debt issuer with a large amount of publicly traded debt, bond investors tend to devote most efforts to assessing the issuer's default risk, loss severity, and market liquidity risk. Moving in the reverse order. Market liquidity risk, well, that's unlikely since it's a large amount of debt is being traded in the market, means there will not be an issue of liquidity. So this is an incorrect option. Loss severity. Since it's a high quality debt, so loss severity would not be a serious concern here. And what is loss severity? We discussed in the previous question. It is the portion of a bond's value, including some unpaid interest, that an investor may stand to lose. So this is again unlikely. Then of course, because it's a high quality debt, so loss severity would not be a serious concern. So what does it mean then? That bond investors now will tend to focus more on default risk then, and that's why it makes A to be our correct option. Next, the expected loss for a given debt instrument is estimated as the product of default probability, and we have read in our text that expected loss is equal to default probability multiplied by the loss severity given default. Sometimes this loss severity given default is expressed as 1 minus recovery rate. So this part is given, the product of default probability times 1 minus recovery rate. So that makes B to be our correct option. All right, now the priority of claims for the senior subordinated debt. Now we have the complete ranking in front of us, and applying this concept, the priority claims of the senior subordinated debt. Where is it located in the ranking? Here it is, senior subordinated debt, given in red color. Is it lower than for the senior unsecured debt? Where is senior unsecured debt? This is senior unsecured debt. Let us mark these first. And I think that's all. Now, the priority of claims for senior subordinated debt, this red mark, lower than for senior unsecured debt? Yes, it stands lower than senior unsecured debt. That means, look no further, it is not the same, not the higher, rather lower than the senior unsecured debt. So that makes A to be our correct option. It is. Next, a senior unsecured credit instrument. Let us mark these so that we make fuller understanding where the location might be. A senior unsecured credit instrument in orange color. Senior unsecured credit instrument, here it is. It holds a higher priority claim other than the mortgage debt. This is the mortgage debt here in blue. Second lien loan in red. So you know the exact locations, it will be easier for you to then give your. And senior subordinated given in black. Now, look at this orange. Where does it stand? A senior unsecured credit instrument holds a higher priority of claim than the mortgage debt. No, it is lower than mortgage debt. Is it higher than the second lien loan? No. Then it is only higher than the senior subordinated debt. So that makes perfect option for our select answer. So that makes C to be our correct option. C. Okay, in bankruptcy proceedings, when the absolute priority claim is enforced. Absolute priority claim. We need to move this way. A senior subordinated creditors, which are placed right here, rank above second lien holders. Wrong. They rank lower than the second lien holder. This is wrong. Preferred equity is totally out of the question. It is not in these arrangements here. Creditors with a secured claim have the first right to the value of that specific property. Now that makes perfect sense. In bankruptcy proceedings, when the absolute priority claims is enforced, creditors with a secured claim have the first right to the value of that specific property. That makes perfect sense, and that is why C is your correct option. Next. In the event of default, which of the following is most likely to have the highest recovery rate? The one that is at the top will the highest recovery rate. Second lien, here. Senior unsecured, here. And senior subordinated, here. So amongst these, this is the one that will have the highest recovery rate in the event of default. So that makes A to be the correct option. Next. The process of moving credit ratings of different issues up or down from the issuer's rating in response to different payment priorities is best described as notching. That is the correct option. Look no further. Notching is the process of moving ratings up or down relative to the issuer rating when the rating agencies consider secondary factors such as priority of claims in the event of default and the potential loss severity. So this is the exact textbook approach-based question. Then what is structural subordination? I'm sure you would remember from your reading. Structural subordination can arise when a corporation with a holding company and subsidiary company structure, it has debt at both its parent level and subsidiary level. Debt at the operating subsidiaries, it is serviced first by the cash flows of the subsidiaries, and then this cash is then remitted or repatriated to the parent holding company. This is called structural subordination. So of course this is not what we are looking here. Alright, so what is then cross default provision? Cross default basically is a provision in a bond indenture or maybe in a loan agreement that puts a borrower in default if the borrower defaults on another obligation. Let's say if you default on this obligation, it is assumed that you have defaulted on obligation A as well. So notching is what we were looking for. A. Next. The factor considered by rating agencies when a corporation has debt at both its parent holding company and operating subsidiaries is best referred to as, we just discussed this a little while ago, that is structural subordination. I discussed this. Credit migration risk. This is credit downgrade, not what we were looking for. And corporate family ratings. Okay, now let's say this is the corporation. It might have issued different types of bonds by various member firms or affiliates. They are part of the same corporate group. So ratings issued to such a group of families or corporate families are called the corporate family ratings. So clearly this is not what we're looking for. So that's clearly C. C is our correct option. Which type of security is most likely to have the same rating as the issuers? Again, a textbook based question, straightforward. The senior unsecured bond. The issuer credit rating usually applies to its senior unsecured debt. Straightforward approach. C is the right option. Which of the following corporate debt instrument has the highest seniority ranking? Second lien is here, senior unsecured here, senior subordinated here. So the highest amongst these three is second lien loan, and that is A. An issuer credit rating usually applies to companies. We just did a question similar to this a little while ago. senior unsecured debt, C. Next, the rating agency process whereby the credit rating on issues are moved up or down from the issuer rating. Issuer rating we just discussed in the previous question 30th, and the previous one as well, is what you call the rating on senior unsecured bonds. So the rating agency process whereby the credit ratings on issues are moved up or down from the issuer rating, best described as notching, right? A process whereby the credit ratings on the bond issues can be moved up or down from the issuer rating. And what is the issuer rating? Senior unsecured loan or bonds. So that is notching. And then what is pari passu making? Pari passu charge means that when the issuer company, that is issued bonds, goes into dissolution, or when there is a liquidation issue, the assets over which the charge has been created will be distributed in proportion to the creditor's respective holding in that particular asset. Basically, it's a Latin term which means on equal footing, proportional. And cross default provision we discussed previously. If you default on your home loan, under the cross default provision means you have defaulted on your auto loan as well. So that's A. Next, the notching adjustment for corporate bonds rated AA2A is most likely. Now let me first show you the rating schedule. Now we are right here, AA2 AA. So remember, as a general rule, higher the senior unsecured rating, that we call the issuer rating, the smaller the notching adjustment, right? So for the corporate bonds rated as AA2 or AA, the rating agencies will typically apply smaller notches up, down compared to the notching adjustment for B2B or the any lower graded bonds. So this would mean that the notching adjustment for corporate bonds rated as A2A is most likely to be small as the notching adjustment, smaller than the notching adjustment of corporate bonds B2B. So that makes C to be the correct option. C. Next, which of the following statement about credit ratings is most accurate? Credit ratings can migrate over time. That is absolutely true. Changes in bond credit ratings precede changes in bond prices. This is totally in opposite order. It should be bond prices change precede the changes in the ratings. First the prices of the bond change, then the rating is revised, not the other way around. This is wrong. Credit ratings are focused on expected loss rather than the risk of default. That's wrong again. They are focused on risk of default. Next. Which industry characteristic most likely has a positive effect on companies' ability to service debt? Low barriers to entry in the industry, which means any firm can enter, any newcomer can enter and share the loot. Not good for the company, not a positive sign for the company's ability to service debt. B. Higher number of suppliers in the industry. That is good for you, for your firm, for this issuer, because suppliers in this industry, they do not have the bargaining power, which is good, which goes in favor for the company and its ability to make profits and ability to service debt. That's true. This is good. B is the right answer. And why not C? Broadly dispersed market share among large number of companies in the industry. That means rivalry is high, so not positive effect on the company. So B is our right option. When determining the capacity of a borrower to service debt, a credit analyst should begin with an examination of industry structure. Yes, that should be the starting point. Industry fundamental. This comes after industry structure, second. And then company fundamental. This is the last. That should be done after industry structure and industry fundamentals have been analyzed. So this is the third stage. So it's sequentially step. So that's the right starting point. That makes A to be our correct option. Which of the following accounting issues should most likely be considered a character warning flag in the credit analysis. Expensing items immediately, well, that's not a cause of concern. That's conservative accounting and it's fine. Changing auditors infrequently, that's good too. Frequent change would have been a cause of concern that maybe the management is trying to cook the book, and that's why there are disagreements between the management and the auditor, and that's why auditors are changing frequently. So AB is not an issue for me. Significant off-balance sheet financing, that's aggressive accounting, and that's a character warning sign. Look no further, C is the right option. In credit analysis, capacity is best described as the quality of management, that is character, ability of the borrower to make its debt payments on time, that is capacity, quality and value of the assets supporting an issuer's indebtedness appears to be the correct option, but B puts things exactly in the perfect order, and that's what we call capacity. Maybe you have good quality assets and large assets, but they are not liquid. They are not able to generate returns. So that puts a question mark on capacity. B is the perfect answer. Among the 4 C's of credit analysis, the recognition of revenue prematurely. Revenue recognition criteria has not been met and the revenue is being recognized prematurely. That puts a question mark on the character. Aggressive accounting, tax strategies. All these are examples of aggressive accounting, recognizing your revenue prematurely, even the revenue recognition criteria has not been met. A. Based on only the leverage ratios in Exhibit 4. Only the leverage ratio. So leverage ratio means out of these, it's a profitability. Profitability is a coverage. So it means these are the leverage ratios. Based upon the leverage ratios alone, the company with the highest credit risk, higher for 2.5 for company C and 46.3. So debt as a fraction of EBIT, this is the highest for company C, and debt to capital leverage is highest for company C as well. So it means company C is the one with the highest credit risk. C is the right answer. Next, based only on the coverage ratios in Exhibit 4, the company with the highest credit quality, coverage ratio, EBIT as a person, how many times can we pay interest out of the earning before interest and tax? This is the highest for company B. How many times can we pay our interest out of the total earning before interest, tax, depreciation and amortization? Highest for company B. So that means our coverage ratio point us to company B being the one with the highest credit quality. Hence B is your right answer. Now we have 2 questions that require some reference to your curriculum exhibits. Use the following exhibits for question number 41 and 42. Which exhibit these? 5, 6 and 7. Exhibit 5 followed by 6 and 7. And what exactly do we need from these exhibit? What do we need to calculate? Let's see the requirement. Based on the exhibits 5, 6 and 7, in comparison to company X, company Y has a higher debt to capital, debt to EBITDA, or free cash flow after dividends upon debt ratio. So we will calculate all these for both companies X and Y, and then we will see through a matrix here which of these is the right option. So let's do it. First we need to calculate debt to capital. So this is the debt, short-term debt for company X, short-term debt for company Y, and this is the long-term debt for company X and Y respectively. And so we have the debt 11.7 plus 0.5, so that gives you 12.2, and in this case 8.7 plus 21.1 gives you a total of 29.8. So this is debt. Debt must be divided with total capital. And what is total capital? Debt plus equity. That is 12.2 plus 1.3. It will give you 13.5. And in this case, 29.8 debt plus 64 equity. Total will give you the capital. That will be 93.8. Now if you calculate debt upon capital for both of these, it will be about 90 point, almost 37, that's 90.4%, and for Y it is 31.8%. So this is one of the first options, A. Next we need to find debt upon EBITDA ratio. So we have the number for debts, but we have to calculate EBITDA for both X and Y. So for that we need to come back to your income statement, change the color. So right here we have our operating income. To this operating income we need to add back depreciation, in amortization, or interest is already before interest income. So we just need to add two numbers, depreciation and amortization. So let's see what do we have for depreciation. Of course they would be given in the cash flow statement, and the cash flow statement is given right here. Depreciation for X is 1 and 3.8. So adding these two will give us EBITDA. So 1.1 plus 1 and 13.3 plus 3.8. So EBITDA for company X it's 2.1, and for company Y it is 17.1. All right, now we already have the numbers for debt, I think somewhere here. 12.2 and 29.8. So let's write this here, 12.2 for X and 29.8 for Y. And we need to divide the debt numbers with EBITDA that we just calculated a little while ago. It was 2.1x for X and 17.1 for Y. So if you calculate, what you get is 5.81 and 1.74. So we will just write all these numbers in the main question, then we will go for the correct or incorrect option. So what is the third option? The option C. What do we need to calculate in option C? Let's see. Free cash flow after dividends upon debt ratio. Free cash flow after dividend upon debt. This is the third measure. Free cash flow can be calculated from your cash flow statement here. This is your cash flow from operating activities, 3.3 and 14.0. From this we need to make adjustments for capital expenditures, and it says free cash flow after dividend. So let us see what do we have for capital expenditures in the investment side. As you can see, less negative 0.6, less negative 1.1 for Y, and the dividend payments are negative 0.3 for X and negative 6.1 for company Y. So what we have, the free cash flow after the payment of dividend is 3.3 minus 0.6 minus 0.3 gives you 2.4. And in here we have 14 less 1.1 less 6.1 gives me 6.8. So what is the percentage? 2.4 upon the debt. The total debt on company company X is 12.2, and the debt on company Y was 29.8. These are the numbers we just used a little while ago. So 2.4 upon 12.2 divided by 100. It's about 19.7%. And for Y it's 6.8 divided by 29.8 times 100, it is 22.8%. So let us tabulate all these and then decide which should be the correct option. Now these are the summary results. Based on the exhibit 5.7, in comparison to company X, company Y has a higher debt to capital ratio. No, company Y has lower. Wrong. A is wrong. Company Y has a higher debt to EBITDA. No, it's lower. Company Y has a higher free cash flow after dividends to debt ratio. Yes, that's the correct option, 22.82. So that makes C to be our correct option. C, as you can see, C is the right answer. Now we'll do the same thing based on exhibits 5, 7 in comparison to company Y. Company X has greater leverage, interest coverage, or operating profit margin. They are very fairly straightforward computations. So leverage we just calculated in our previous question. Let us write this down. For A, leverage. Then we'll calculate the interest cover, and then we'll calculate the operating profit margin. So the numbers were 90.4% and 31.8%. Let's calculate the interest coverage now. Now this is the operating income for X. This is the interest expense, operating income, interest expense. So we can calculate 1.1 upon 0.6 and 13.3 upon 0.8. So 1.83 is the interest coverage for company X and 16.62 is the interest coverage for company Y. Let's plug these numbers there. So interest coverage for both X and Y. Let us now calculate the operating profit margin. Operating profit margin is calculated by dividing your operating income with your revenue. So it's going to be 1.1 divided by 50.7. It's 2.17%. And for company Y, 13.3 upon 83.7, it's about 15.9%. So all the results written here. Company X has greater leverage, yes. Interest cover, low. Operating profit margin, low. So that is A. A is the correct option. A it is. Credit yield spread most likely widen in response to high demand for bonds. Credit yield spreads will squeeze. Strengthening economic conditions, credit yield spreads will be narrow. But weak performance of equities, that indicates weak financial markets. This would result in credit spreads becoming wider. B is the right answer. This question is similar to the previous one. The factor that most likely results in corporate credit spreads widening. An improvement in credit cycle? No. That will reduce the credit spreads. Period of high demand for bonds, that will reduce. Weakening economic conditions, this will widen the credit spread. So that is the right option. B. Credit spreads are most likely to widen in strengthening economy? No. As the credit cycle improves? No. In periods of heavy new issue supply and low borrowers demand? Same things asked from different perspective, but the result stays the same. Which of the following factors in credit analysis is more important for general obligation, non-sovereign government debt than for sovereign debt? Per capita income, sovereign debt. Power to levy and collect taxes, that's the sovereign debt. But requirement to balance an operating budget, that is specifically to non-sovereign government instruments, because these governments will have to balance their budgets and they lack this discretion of collecting taxes and other revenue streams. So that C is the right option. Next, in contrast to high yield credit analysis, investment grade analysis is more likely to rely upon. Most investors in investment grade debt focus on spread risk, that is the effect of changes in spreads on prices and returns, while in high yield analysis the focus on default risk is relatively greater. So that makes A to be our correct option. Last, which of the following factors would best justify a decision to avoid investing in country's sovereign debt? A freely floating currency, that is good. Suitable checks and balances in policy making, that is good as well. But a population that is not growing. So a relatively younger population normally means the economy is growing, it will contribute more towards the GDP. But if the population is not growing, that indicates that this would be the wrong decision to invest in such a sovereign debt. So if the population is not growing, it is a right decision to avoid investing in this country's sovereign debt. So that makes B to be a correct option, and it ends our EOCs.